Hey, good morning, everyone. Marty Mazzora here. It is the 8th of March, 2026, with your weekly update. This one is going to be pretty quick, although I do tend to ramble as I get going, but my intent here is to be very specific and focused primarily on one obvious topic and the market reaction to it. So I'm going to start by paraphrasing my notes from this week. To start with, the one I added this morning speaks to something that I posted just internally in our internal communication within the company this last week. What I posted was just a comment that I wonder if the Iran situation isn't the blow-off top in geopolitical risk for 2026. And I featured in that commentary just a snip of a report verified out of Russia that Russia was willing to accept the security guarantees for Ukraine, which is something they were, I believe, adamantly opposed to earlier. And that's viewed as a big step in the right direction for peace in Russia and Ukraine. So coming into this year, our view was that the geopolitical headwinds would abate post anything that happens in Iran. And obviously the underlying assumption there is that whatever happens in Iran would be relatively contained, and that is not showing up as the case as I speak at you here this weekend. And that the tariff headwind would also abate as geopolitical risk abates and so forth. So this morning what I posted was this, and this is news out of China. China hails landmark year in U.S. ties despite widening Iran war. China's top diplomat, Foreign Minister Ye, declared that 2026 could be a landmark year for U.S.-China relations if both sides treat each other with sincerity and good faith. He urged a ceasefire in the conflict, of course, and emphasized that hostilities would not affect Xi's meeting with Trump in April. And I mentioned, I think here, certainly talked internally about the fact that I think at least the plan is for those two to be embracing after that summit and talking about the gains that they've made or the progress that they've made toward extending the tariff truce, maybe even lightening it up a bit, yada, yada. So I think that is the intent. Both sides, I believe, want to come through that with a lot of positivity. And that's kind of what I'm talking about in terms of geopolitical angst waning a bit. And of course, it's hard to hear myself say that in light of what's going on in the Middle East as I speak. And then just kind of thinking on paper, wrote it in a manner that I could also enter it on the blog, but rather than making a written post out of it, I just thought I'd paraphrase it here. So thinking through present dynamics and our positioning, we've seen what is probably our worst week in well over a year in the core portfolio, and that's for portfolios that have more than 100,000 in them in terms of our overall core allocation. We have different allocations for smaller accounts that you wouldn't put 50 positions in. Still up just under 5% year to date as I type, while U.S. major large cap equity averages, save for the equal weight average, which is up 3%, are down over 1%. So the Dow, the S&P, the NASDAQ, and so forth. Today, we experienced a more common theme that hasn't been the case as much this week, and today being Friday, where the equity market sold off notably. S&P was down over 1%, as was the equal weight even, and the Dow near that. NASDAQ well over 1%. Our core allocation was only down 0.31%, so it fared much better. And clients, I know you've gotten kind of used to that until lately, the last week in particular. The negative results this week are the result of essentially the things that have been working for well over the past year and a half rolling over notably, i.e. commodities, commodity producing regions, and to a lesser extent, non-U.S. exposure in commodity consuming regions. Now, the latter is more intuitive, the consuming regions suffering, given the big spike in oil prices, i.e. commodity consuming regions stand to lose if higher oil prices persist. The less intuitive hit, when I'm thinking strictly about commodity prices, is to the commodity producing regions. Clearly, the market is pricing them lower based on the flight to the dollar. Emerging markets have a very negative correlation to the dollar. Thus, it makes sense to get a strong selling impulse in those areas, particularly since they've seen such dramatic outperformance of late. But thinking beyond the short-term textbook reactions, however, all else equal, these areas ultimately should enjoy, or could enjoy, a notable tailwind on the notion that the present crisis could inspire higher across-the-board commodity prices. However, all else not equal, if present uncertainty persists or exacerbates and becomes a protracted affair, the negative effect on the global economy would lead to reduced commodities demand, leading to further negative results among the equities of commodity-producing regions. So when you have these conflicts and you have these supply disruptions and so forth, the places in the world that don't, let's say, transport commodities through the Strait of Hormuz could stand to benefit in a big way. However, in this global risk-off week we had last week, even those that you might have thought would do pretty well, like last year when the market was selling off and we weren't, was largely because of this commodities exposure. Well, that hasn't been happening of late, despite the fact that you might think that money would flow there, given what I just said. So what we do right now, of course, is just watch closely and definitely do not overreact. We have made some shifts in the portfolio of late. Ironically, one that we added and added to of late actually was up last week, and that was in U.S. software that had been kind of beaten to smithereens. Other things that did well last week were ag commodities, and I'll show you that on the charts, and that's not a small position for us either. So we actually had some things that did really well last week, but overall, it was an ugly week for us, just like it was most other markets. Okay, so speaking of commodities, here's our chart that covers oil. This is WTI and Brent crude, these first two here. Nat gas, gold, silver, copper, platinum, palladium, and gasoline. So, folks, unfortunately, of course, oil, natural gas, and gasoline, and this is the one that's really tough and politically a problem if it were to continue, up 21% last week. Oil up 35%, natural gas up 11%. Other precious metals and industrial commodities, if you will, all were down. The biggest losers last week were platinum and palladium, down 9% each, and silver down almost 10%. Gold held up, down 2%, so that was good relative to other commodities here, but not intuitive. You would have thought the gold would continue its ascent given all of the geopolitical uncertainty. I mentioned agricultural commodities, everything except orange juice, cotton, live cattle, and lean hogs actually caught a pretty nice bid this last week, as you can see here. That's expressed in our portfolio is with the PDBA or DBA, depending on your portfolio. This is the most liquid ag futures ETF, and it's been a real important position for us over the last few years. As you can see, it was up pretty nicely this last week. Well, again, most of the world was down, so that was something that was welcome and something we like because it really doesn't correlate to the stock market overall. As for the stock market, here's that daily one-year chart of the S&P 500. Remember, we had this trading range in here. Well, we broke and closed below that on Friday. Remember I said if we break that, not much technical help before you get to the 200-day moving average. So that would be the direction here. Technically speaking, there's I think pretty high odds that we'll go at least that much further. Of course, a big change or improvement in the geopolitics of the world would of course say something different right here, but momentum continues to fall. We're not oversold just yet. So, I think there's more near-term downside to be had for the U.S. market, certainly when I look at the technicals. As for the NASDAQ 100 index, it actually has been holding in pretty well right here and finding support right here at about 600 on this QQQ ETF, which tracks the NASDAQ 100 index. And the momentum actually is bullish. We actually have, believe it or not, a bullish divergence building on the NASDAQ. So we have the pricing staying right here at this kind of flat level while underlying momentum is beginning to pick up. Thank the software space for that, as I mentioned earlier, as being the area within tech that's actually having a pretty good go of it of late. And then the dollar has been rallying strong, which is textbook, right? The world is scared. The dollar is the world reserve currency and the safest currency in the world, so it's been catching quite a bit. That also, of course, speaks to the weakness in commodities and the weakness in emerging markets, which I read to you from my own comments. What may be, at least at first blush, counterintuitive is the rally in yields. This is a 10-year Treasury yield. You can see it's been going up quite notably during the crisis here. Now, the Treasury is the safest fixed income vehicle in the world, so often, and this would be textbook, you would see Treasuries rally and this yield going down in a massive geopolitical event. Well, it's the nature of this event and what it says about near-term inflation risk that is inspiring a sell-off in Treasuries. And here it's expressed with CPI swap rates or inflation break-evens. Now, these aren't super high at 2.5% on the 5-year, roughly 2.5% on the 10-year, 2.5% on the 2-year. But directionally, that is quite the spike higher, and it's telling you the market is discounting higher inflation risk going forward. Now, again, as I read to you already, if this is a prolonged affair, again, oil prices stay higher, but the economy rolls over, right? And then you have your recession. I do think as the economy wanes and unemployment rises, despite the oil shock, I do think the Fed will engage and will reduce short-term rates, perhaps aggressively, which would be a boost to asset prices that are currently getting taken out to the woodshed. And I say that, taken out to the woodshed, but really when you think about the risk inherent in what we're seeing in the headlines, even as of this morning, what are we, 4 or 5% off of the all-time highs in the S&P? That's nothing. We're not even at 10% correction level here just yet. So that will come, I'm certain, if this Middle East situation persists. And right now, all indications are that it's not going to go away tomorrow, to put it lightly. Okay, and then lastly, just to look at gold. Gold's just kind of been hanging in here in this kind of wide, I guess you might call it a consolidation range. It was up on Friday, and you can see it gap down right here. That was that liquidity event that I explained in the written blog. Gold is liquid. It's an asset that you can catch a bid on. So, for example, when portfolios galore are getting margin calls and they have to come up with cash, well, gold's the one thing in there that can be sold to satisfy those margin calls. So there was that very mechanical sell-off that I expressed in an earlier week blog. So if you didn't see that one, I would encourage you just to look at the blog homepage. I think it was the last written blog post or the one just before that. So I give you the details and a summary of the different kinds of strategies that essentially were inspired just to push the sell button. And of course, gold and everything else got caught up in that sell-off. So there was quite a bit of macro data during the week. I'm not going to get into that just yet. I haven't yet scored our economic index or our PWA index. I'm going to right after I finish the video. But it's not going to look bad. It's still going to be positive. The employment report on Friday at first blush was not good. 92,000 jobs lost, et cetera. However, in the details, there were some positives. The hours worked held at 34.3. While average hourly earnings rose 0.4% on the month. That's not bad. And a similar gain in January, and that's 1/10 above what the estimate was. ADP, the private sector payroll, showed an increase slightly above what was expected. Initial jobless claims were little changed on the week. The Challenger report for March showed a slowing of the pace of firings in the U.S. And then the February Institute for Supply Management Services Index jumped to 56.1, which really denotes a real jump in optimism from 53.8, and the estimate was 53.5, and that's the best level since July of 2022. These things will roll back over, of course, if this energy price shock persists. And even inside of the internals there, we're still seeing too many commodities up in price And everybody continues to complain about the tariff hit that they're having to manage. And that's one of the reasons why I anticipate or have anticipated that that's going to be alleviated to some degree, perhaps a notable degree, as we get closer to the end of the year, specifically closer to like midterm elections and so on. So folks, I'm going to leave it there for today. Hope that helps you kind of get a feel for conditions, how we view them, what we're doing and not doing in reaction to it. And I will definitely be keeping you posted frequently as we move forward. Thank you as always for watching and listening. Hope you have a great rest of your weekend. Bye-bye.